Buenos Aires, December 2nd, 2001, a Monday morning. You are a school teacher, 11 years of salary deposited on time every month into one of the largest banks in the country. Not a fortune. Enough. Enough for a daughter's university fees. Enough for a water heater. Enough to feel, for the first time in your adult life, like the ground beneath you is solid. You leave your apartment at 7:40. 6 blocks. You have walked this route dozens of times. You need 200 pesos for the week. There is already a queue outside. You join it. You wait. The doors do not open. On the glass, taped at eye level, slightly crooked, is a government notice. You read it once, then again. The language is bureaucratic, almost calm. What it describes is not calm. Effective immediately. Withdrawals limited to 250 pesos per week. No transfers abroad. No exceptions. The man behind you exhales. A long, controlled breath, the kind that is not quite calm. Behind him, the queue grows. A man in a suit, an older woman with a canvas bag, a mechanic in work clothes. All of them reading the same notice. All of them carrying the same expression. Not panic, not yet. Something quieter than panic, something closer to the specific disorientation of a rule you believed in being canceled without warning. Here is the thing. You did nothing wrong. You paid your taxes. You deposited through the proper channels into a licensed institution exactly as you were told to. The money is yours. Your name is on the account. The balance is on your last statement. Legally, unambiguously, yours. And yet you cannot reach it. The question none of them can answer yet: how does money you own become money you cannot touch? When you deposit money into a bank, the bank does not store it, it lends it. The salary that arrived electronically, the cash you handed over, it is immediately deployed into mortgages, corporate loans, government bonds, consumer credit. What remains in reserve is a fraction, a small fraction. The rest is working somewhere in the economy, earning interest, funding someone else's expansion. This is not a flaw in the system. It is the system. It works because most depositors leave most of their money in place most of the time. The gap between what the bank holds and what it owes is never tested simultaneously. Under normal conditions, that gap is invisible. You do not see it. You do not need to. The mechanism that makes banking productive is the same mechanism that makes it fragile. The strength and the weakness are the same valve. Let me show you how this worked. On March 6, 1933, President Roosevelt signed Proclamation 2039 and closed every bank in the United States. Not for hours, not for a day. 4 days, and many banks never reopened at all. Between 1930 and 1933, approximately 9,000 United States banks had already failed, wiping out deposits across the country while families stood at counters and were told their accounts could not be accessed. The 1933 bank holiday was not a sudden shock. It was the terminal point of a 3-year confidence erosion. The moment the gap between deposit claims and available reserves was finally tested at full scale. Consider what that means. Not one crisis, not one bad institution, 9,000 failures across 3 years before the government finally closed everything at once to stop the bleeding. What triggered the cascade was not fraud, not mismanagement, arithmetic. When enough depositors decided, within a short enough window, that they wanted their money back, the reserves were not there. The bank could not refuse the legal claim, but it also could not honor it. The institution that had functioned normally the week before could not function at all by the following Monday. You are not dealing with a dishonest institution. You are dealing with a structurally insolvent one. Those are different diagnoses. The trigger sequence follows the same architecture every time. A confidence shock, a bank failure nearby, a currency announcement, a political crisis, causes some depositors to accelerate withdrawals. Reserves begin to drain faster than they are replenished. The bank applies for emergency liquidity. Public statements reassure depositors. Then withdrawals accelerate further because the reassurances themselves signal that reassurance is needed. The reserves drain past the point where normal operations can continue. The freeze is not the failure. The freeze is what the system looks like under pressure. Cyprus in March 2013 completed this entire sequence over a single weekend. On Saturday, March 15th, the government announced a bank holiday. By the following Tuesday, banks had still not reopened, because the terms of the bailout agreement with the European Union and International Monetary Fund were still being negotiated. Uninsured deposits above 100,000 euros at Bank of Cyprus were ultimately converted into bank equity. Between Saturday morning and Tuesday afternoon, a legal claim became something structurally different. The ownership did not change. The value of that ownership did. Same pressure, same sequence, same outcome. 90 years apart. This is not a failure of trust. This is the revealed architecture of what a deposit actually is. When you deposit money, you become a creditor of the institution. You hold a claim. In normal times, that claim is honored instantly, automatically, invisibly. Under stress, the ability to honor that claim depends on conditions entirely outside your control. Reserve levels, interbank lending, central bank decisions, government policy. You own the claim. You do not control what the claim is worth when you try to exercise it. 6 countries will demonstrate this in the next section. The details will differ. The structure will not. The freeze is not what breaks the system. The freeze is what the system looks like when there is nothing left to hide. The sequence is almost always the same. It does not matter whether the country is in South America or Southern Europe. It does not matter whether the currency is a peso or a euro. It does not matter whether the government is a democracy facing an election or a technocratic administration facing a creditor. The architecture of a banking freeze follows the same 4 phases: quiet stress, confidence break, freeze, controlled reopening, with restrictions. Phase 1 begins before anyone outside the banking system can see it. Interbank lending tightens. The central bank starts providing emergency liquidity through channels that are not publicly announced. Officials issue reassuring statements about the soundness of the banking system. Those statements are accurate at the moment they are made. They are also the first symptom. In Argentina, this phase ran through November 2001. Deposits had been declining for months as Argentines with access to foreign accounts quietly moved funds abroad. On December 1st, Economy Minister Domingo Cavallo announced the corralito. Withdrawals limited to 250 Argentine pesos per week. Transfers abroad prohibited entirely. The freeze did not arrive as a shock. It arrived as a formalization of what had already been happening inside the system for weeks, while the public statements said otherwise. Phase 2 is the confidence break, a single visible event that converts slow outflows into sudden acceleration. It can be a bank failure, a currency announcement, a political resignation, a leaked document. The specific trigger matters less than what it does to the people who have been watching and waiting. In Greece, the trigger arrived on June 26, 2015, when Prime Minister Cyprus announced a surprise referendum on bailout terms. Within 48 hours, Greeks withdrew an estimated several billion euros from ATMs across the country. By the evening of June 28, a Sunday, the government announced capital controls effective the following morning. Withdrawals capped at 60 euros per day. Bank branches closed. Not days of warning, not hours. The window was measured in the time between a Sunday evening announcement and Monday morning. Phase 3 is the freeze. Banks close, ATM limits are imposed, transfer systems are suspended or restricted. In Cyprus in March 2013, the announcement came on a Saturday. Banks were already closed for the weekend, and the bank holiday was extended until Tuesday, then extended again while negotiations with the European Union and International Monetary Fund continued. By the time Cypriot banks reopened on March 28, uninsured deposits above 100,000 euros at Bank of Cyprus had been designated for conversion into bank equity. Not delayed, not restricted, converted. In Lebanon, the freeze sequence arrived in a different form. Beginning in October 2019, banks started informally restricting foreign currency withdrawals and international transfers, without any formal legal authority. Individual banks set their own limits, varying by institution, changing week to week. The formal controls followed the informal ones, same sequence, different scaffolding, same outcome. Iceland in October 2008 moved through all 4 phases within days. On October 6th, the Icelandic parliament passed the Emergency Act. Kaupthing, Landsbanki, and Glitnir, 3 banks holding assets equivalent to approximately 10 times Iceland's annual economic output, collapsed within the same week. The speed was exceptional. The sequence was not. Phase 4 is controlled reopening, and the word reopening requires careful attention because what reopens is not what was there before. Daily withdrawal limits remain. Transfer restrictions remain. Deposit tiers are introduced. In Argentina, reopening came with pacification. Dollar-denominated deposits were converted to Argentine pesos at 1.4 pesos per dollar, a rate that did not reflect the exchange rate that followed in the weeks after. The number in the account changed. What it could purchase changed further, while depositors stood in line waiting to access what remained. You followed the rules. You kept your money in a licensed institution. You did not speculate. You did not take risks. And in each of these 6 countries, at the moment the sequence completed, the people with savings in accounts, the people who had done exactly what the system encouraged them to do, found that following the rules had not protected them from the rules changing. This is not 6 separate crises. This is one mechanism expressed 6 times across 6 different political and monetary contexts. Same phases, same pressure points, same outcome. The quiet stress phase is the system losing reserves faster than it can recover them. The confidence break is the moment depositors collectively recognize the gap. The freeze is the institution acknowledging it cannot honor all claims at once. The controlled reopening is the government managing the conditions under which partial access is restored. What changes between Argentina in 2001 and Cyprus in 2013 and Greece in 2015 is the political framing, the legal instruments, and the specific numbers. What does not change is the load-bearing structure underneath. The protection was available. The window was not. Across all 6 crises, depositors did not simply freeze. Some of them moved. They pulled cash, converted currencies, shifted funds abroad, bought gold, acquired property. The alternatives existed. The question is what each one actually protected against, and what it did not. Here is the structural lens that cuts through all 5 options. How much did each one depend on the system continuing to function in order to deliver its protection? The closer an option stayed to the domestic banking system, the more it absorbed that system's failure. The further it was from it, in form, in jurisdiction, in physical independence, the more it retained its function. The first option is cash held outside the banking system. Physical currency, at home, in a safe, anywhere outside a branch. In the weeks before the December 2001 corralito announcement in Argentina, depositors who anticipated the freeze withdrew cash from the system. Those who held physical peso or United States dollar cash outside the banking system retained immediate liquid access through the freeze. The 250 peso weekly withdrawal limit did not apply to cash already in their possession. The cash survived the freeze. The purchasing power did not. After Argentina depegged the peso from the United States dollar in January 2002, peso-denominated cash lost substantial purchasing power in the months that followed. Cash outside the banking system bypassed the access restriction. It did not bypass the monetary response that followed. The second option is foreign currency holdings in physical form. In Lebanon, beginning in 2019, physical United States dollar cash and gold traded at substantial premiums over the official exchange rate on parallel markets. Depositors who held physical dollar cash retained transactional purchasing power throughout the banking freeze, in an environment where Lebanese pound savings were being simultaneously restricted and losing value. Foreign currency accounts held within domestic banks were subject to the same capital controls as pound accounts. In Lebanon, banks restricted foreign currency withdrawals before any formal legal authority existed to require it. The currency provided protection. The account holding it did not. Same asset, different container, different outcome. The third option is precious metals held physically outside the banking system. Gold is not a deposit. It does not require an institution to honor a claim. During the Lebanon crisis, gold traded at a premium on informal markets, while domestic accounts were frozen. During the Greek capital controls period beginning June 28, 2015, when ATM withdrawals were capped at €60 per day and bank branches closed, physical gold remained accessible to those who held it. The controls applied to accounts and transfers, not to metal already in hand. The gold survived the freeze until the law reached for it. On April 5, 1933, Executive Order 6102 required United States citizens to surrender gold coins, gold bullion, and gold certificates to the Federal Reserve at a fixed price of $20.67 per troy ounce under penalty of fine or imprisonment. The asset held outside the banking system was absorbed by the government's response to the crisis in that banking system. Not damaged, not frozen, confiscated by legal order. This was a specific policy in a specific political moment. Wartime emergency powers in the depths of the Great Depression. But it establishes the outer boundary of what is possible. In sufficiently severe crises, the reach of state intervention does not stop at the bank's door. It extends to whatever the government decides the crisis requires. The protection functioned until the state decided otherwise. The fourth option is foreign bank accounts, deposits held in institutions outside the domestic banking system, in a different jurisdiction. In Cyprus in March 2013, depositors who had transferred funds abroad before the Saturday bank holiday announcement retained full access to those funds throughout the freeze. The controls applied to Cypriot accounts in Cypriot institutions. A deposit in a German or British bank remained fully accessible. The window between the announcement and the closure of the transfer system was approximately 48 hours. Not days to respond, not a full weekend, 48 hours. From Saturday announcement to Monday operational closure was the entire window available to act. For the majority of Cypriot depositors, 48 hours was not enough. Not because they were slow, because Saturday was the first public signal most of them had received. Foreign accounts protect only when the foreign institution itself remains solvent. In October 2008, Landsbankie's iSave product held deposits from approximately 340,000 British and Dutch retail customers. When Landsbankie failed, iSave access was suspended immediately. A dispute over deposit guarantee obligations between Iceland, the United Kingdom, and the Netherlands lasted several years. The foreign institution failed. The claim on it failed with it. The account was in a different country. The structural problem was the same. The fifth option is real assets, property, physical inventory, productive land. During the Greek capital controls period of 2015 to 2016, property ownership and physical inventory remained outside the reach of deposit restrictions. Businesses holding physical stock or productive assets continued operating where bank-dependent businesses could not. Real assets sit entirely outside the deposit system. Capital controls cannot reach them. The limitation is immediate and direct. You could not sell the property. You could not convert the inventory at market prices. You could not extract cash from the land. Real assets preserve underlying value across a crisis, but cannot substitute for liquid funds in the short term. The building remains standing. The owner could not pay the week's wages. This is not a ranking of good and bad options. This is a forensic analysis of what each option protected against and where each one broke. What these 5 options collectively demonstrate is a single structural principle. Protection against a banking freeze requires physical or jurisdictional distance from the domestic banking system. And that distance has to be established before the system signals that distance is needed. The options that required acting in advance provided protection. The options exercised after the announcement provided almost none. The protection was available. The timing to use it was not. Most people who lost access to their savings during a banking crisis had not done nothing. They had done something. They had thought about the risk, identified an option, taken what felt like a reasonable precaution. The problem was not passivity. The problem was timing. Every documented case shows the same diagnostic. The majority of depositors who attempted to protect themselves did so after the freeze had already been announced. By that point, the window had closed. The transfers were blocked. The controls were in place. The protection they sought required acting before the system gave any visible reason to act. In Cyprus, in March 2013, the bank holiday was announced on a Saturday. By Monday, transfers were blocked. Depositors who had moved funds to foreign accounts before that Saturday retained full access to those funds. Depositors who attempted to move funds after the announcement could not. Approximately 48 hours between a Saturday announcement and a Monday operational closure was the entire window available to act. For the majority of Cypriot depositors, 48 hours was not enough. Not because they were slow, because Saturday was the first public signal most of them had received. The second structural risk is the reach of controls beyond what depositors anticipated. Controls are not limited to bank accounts. They follow the shape of the crisis. In Argentina, during the corralito period, beginning December 2001, authorities restricted access to safe deposit boxes held within bank branches, limiting when and how depositors could access physical contents, including cash and valuables stored entirely outside deposit accounts. The reach extended to the building, not just the ledger. In the United States in April 1933, Executive Order 6102 required citizens to surrender gold coins, gold bullion, and gold certificates to the Federal Reserve. The option that had functioned as a protection against banking instability was reached by the government response to that same instability. The gold survived the bank freeze. It did not survive the policy that followed. The third structural risk is the partial protection problem. Each option solved one failure mode while leaving another open. Foreign currency protected against the freeze, but not against forced conversion. Real assets protected against deposit restrictions, but not against the collapse in transaction liquidity that accompanied a full banking shutdown. Cash held outside the banking system protected against the initial freeze, but exposed holders to the monetary expansion that typically followed. Same crisis, different phase, different exposure. The middle class faces this asymmetry most acutely, and not by accident. The options that offer the broadest protection, diversified foreign accounts, physical precious metals, real assets in stable jurisdictions, require capital, advanced preparation, and understanding of the mechanism before the crisis signals it. The depositors most dependent on domestic bank accounts are, by definition, the ones who have not yet accumulated the resources to move beyond them. You followed the rules. You saved through the proper channels. You did what the system encouraged you to do. The options that would have protected you required acting as if the system might fail, long before anyone around you believed it would. And acting that way requires both knowledge and the financial position to do something with it. Most people had neither. That is not a personal failing, it is a structural one. What separated the depositors who preserved their financial position from those who did not was almost entirely determined before the crisis became visible. Not during the freeze, not during the controlled reopening. In the ordinary months when nothing appeared to be wrong, when the bank statement arrived on time, when the ATM worked on the first try, when the balance looked exactly right. The window does not open when the crisis arrives. The window closes. 6 countries, 6 governments, 6 different currencies, political contexts, and stated causes of crisis. Argentina in 2001. The United States in 1933. Cyprus in 2013. Greece in 2015. Iceland in 2008. Lebanon in 2019. The sequence was nearly identical every time. What that pattern reveals is not a record of policy failures scattered across different eras. It is a diagnostic, the same load-bearing constraint built into the architecture of deposit banking itself, producing the same outcome whenever the same pressure is applied. Research published by the International Monetary Fund documented over 150 banking crises globally between 1970 and 2017, occurring across advanced, emerging, and developing economies. Not occasional failures, not rare exceptions. 150 crises in less than 50 years. The frequency is the finding. Banking crises are not accidents that happen when something goes wrong. They are recurrent features of how the system behaves under stress, and the stress arrives regularly. Let me show you the mechanism underneath the pattern. A bank deposit is a legal claim on an institution, not stored property. The institution holds only a fraction of that claim in liquid form. Under normal conditions, this gap is invisible. Under stress, it becomes the only thing that matters. The institution cannot honor all claims simultaneously, not because of fraud, not because of mismanagement, because the system was never designed to do that. This is not a series of crises. This is one mechanism expressed 6 times. The middle class sits at the center of this exposure, not because it is targeted, because it is structurally positioned there. You hold your savings in domestic accounts. You are the population most dependent on the system functioning normally, and the population least positioned to hold assets outside that system before the crisis signals you should move them. The people who came through these 6 episodes with their savings largely intact shared 2 things. They understood how the claim worked, and they had enough financial room to act on that understanding before the pressure arrived. Knowledge alone was not sufficient. Neither was capital alone. It required both. Between 1930 and 1933, approximately 9,000 United States banks failed. The families who lost their savings in those failures were not speculating. They were depositing. They were doing exactly what the system encouraged them to do. By the time the 1933 bank holiday arrived, the damage had already been accumulating for 3 years, while the institutions kept opening every morning, while the statements kept arriving on time, while nothing appeared to be wrong. Same system, same design, same result. Here is what the 6 cases collectively establish. The lesson is not that the system is dangerous. The lesson is more precise. A deposit is a claim. The access to that claim depends on the institution's ability to honor it, and that ability is subject to conditions outside your control. When those conditions change, your legal ownership does not change. Your practical access does. Not adjusted, not delayed, gone. Until the institution, the central bank, and the government decide together what terms of access are permitted next. The Buenos Aires schoolteacher standing outside the locked branch on December 2, 2001, was not witnessing an Argentine problem. She was not witnessing a failure of a particular government or a particular bank. She was standing at the surface of the structure. She was seeing what was always there.